Okay, welcome back. Yeah, I know it's been a little while. I appreciate all of you who spend your time, watch the videos on the YouTube channel and the blog, and even send me a question now and then. So, what I want to do, I'm going to do a series about designing a trading method. Now, our overall trading plan is going to involve three things: a method that we're going to use to see markets and trade, money management that's appropriate to that method, and the mindset we approach it with. So, what I'm dealing with now is the method part. And what I want to do is offer some ideas and be a guide to thinking about how to design your own methods. If we understand some things about price, we can begin to do that. So it's not just some method that we learn to do by rote, do this, one, two, three, and a setup and follow this. Everybody is a little bit different in how they see things, and so we all need a method that fits us. And when you participate in authoring the method yourself, you own it. There's something a little bit different than if you're just following the instructions from some course. So the main thing I want to do in this first part, in this first video, the main thing I want to talk about is, if we're going to build a method, I want to understand how price moves in its cycle. A swing cycle moves in process, and so we're really going to concentrate on this little piece right here in this session, just so we could really understand about the way price moves. If we can understand how price moves, then we have a solid foundation from which to build on. And so this is all we're pretty much going to concentrate on, and we'll talk a little bit about it. I'm not going to be teaching any setup methods here or anything else today. We're just going to talk about understanding this, because if we don't understand this, how are we going to build methods? So if we are to design some trading methods, we need to design them around price flow principles. They have to adhere to certain principles. So that's what we're going to try to understand today. And the method doesn't need to be complicated. It looks like I got a lot going on here, but it doesn't need to be complicated, because all market structure, and market structure is structuring price flow, structuring a gap, structuring a mountain. All market structure is a derivative of gaps and swings. That's it. That's the foundation. Gaps and swings. All of it. So if you understand this, it moves in a process. The gap is the impulse. It's the first part after the contraction. Everything moves in contract, expand, contract, expand. And we need to learn to see it in relative forms. Just like, you can see here, contract, expand, contract, expand. So if we understand the way a swing cycle moves and the process of it, each part of this process, right? Everything moves in process. It doesn't have a choice. A swing needs to be born, it needs to grow, it needs to go through certain steps. If we understand each part of the process, then we'll begin to notice that each part of the process of a swing cycle has its own characteristics. And then we can design methods and tactics for these isolated parts of the cycle. So this growth part will be more of a momentum kind of a method, which is going to be different than if we say trade here at the bottom of a swing in this swing trading method. And there can be tactics for each part. These circles are each part of the cycle, and places we can build methods for trading if we understand them, and those methods will have their own money management. So if we look back over here, so I want everybody to understand this. This isn't just trying to memorize steps. If you've traded at all, you know it's easy to recognize when price starts to spurt, right? Starts to run, starts to blow up. It gets excited, it moves fast. We call that a gap. Wide range bar gap, it moves fast. You know the excitement as it gets up here, right? If you've ever been out of control, and we all have, I've done it too, it gets excitement, get me in. I just want to be part of it, take me home. Alright, so there's this excitement up here. And generally after an impulse, a gap, a burst like this, there'll be a little bit of momentum that go on for a little while. Now, just imagine you're the trader that bought it here or here, and these can be fine tactics as long as you know what you're doing with them. But imagine if you're the person who buys it along here, if price starts to fall back, you're going to be gone rather quickly. It's just normal. It's just how the cycle gets built. And if we understand that, we can play this part and we can play this drop. We can understand it. So the first thing is we need to learn to identify it on a chart in its relative forms and understand it. So the definition of a wide range bar gap having to do with just one bar is it's a wide range bar, which means bigger than the last 3 bars at least, with a space between the previous bar and the subsequent bar, between the previous bar and the subsequent bar. You see there's a space here. This is empirically just, it's a gap. You know, we have 24-hour markets now. You know, back in the early stock markets, there'd be news overnight and they'd adjust the book and price would gap to reflect that. But this is the same thing. There's this excitement here. Now this little piece is no different than a swing. Think of this as this. This is the impulse leg, right? It's impulsing. It's going. It's just in relative form. See? You can see the difference, right? You can see how fast this is moving compared to this, right? You can see, right? You can see the space in here. Now if you look, you can see the same dynamic. And again, try and understand this. Once this thing starts to really take off and get some steam, people are jumping in for whatever reason. So if you're the person that jumps in here, and a lot of people, you know, they're buying breakouts. If you're the person who jumps in here or even tries to trade this little swing or this little swing, there's nothing wrong with that if that is a tactic you've worked out. But if you're the person who buys this and price starts to come off, you're out of here, right? That's why you start to get moves like this. So all I'm going to do in this video is try and get that dynamic across, and you can see it in any market, actually anything you can chart. Just understand this dynamic before we get started. And so here it is in a bar form. You can see it. So imagine it like this. It's just contracting here. You don't know what will happen. And then boom, look, you see the size of the bar. And now that is starting to taper off. Right? There's this initial excitement where, hey, jump in, get me in. And you have people buy stopping your way in, people jumping on in, and it feels like if you don't get in now, you're going to miss the whole swing. And sometimes it does keep going, right? It contract, expand, contract, it can expand continue or expand reverse. So sometimes it does, we don't know which, but there's a dynamic that if you end up doing trades in here, or if you end up doing trades in here, if this thing starts to come off sharply, you're going to get yourself really upset. I'll never do that again. But you can see it's just part of a swing, really. Now, of course, you never know if it'll keep going through or if it'll keep going up, but just notice this dynamic in anything you're looking at. That's all I really want to get across in this video. So this is an Aussie CAD that we worked earlier in the week, and I'll just show it to you today in the S&P E-mini, just so you can get used to seeing and understanding this, right? So you can see this is no different. You get this bust through here, and you know what it looks and feels like, especially first thing in the morning. Oh my God, there it goes. You want to get on. People who are short, oh my God, I got to get out. There's this momentum, and there's ways to trade this momentum. This is the first part of a possible swing cycle. But you'll see it over and over, and after the initial boom, it starts to level off. Okay? And we call this a gap slide. It's just, you can visually see the angle change, right? The momentum's changing. Now, rather than look at statistics, just realize if you were the person who bought that, you were the person who bought the breakout, you were the person who just couldn't help themselves, you were the person who bought this swing if it comes down. If price starts to come back, it's liable to cause a big bar back down, like another gap down. It's liable to cause a big bar back down. Why? Because all these people are going to run for the hills. They're not putting their stops down here. And there's nothing wrong with trading this part of the cycle as long as you have tactics and money management for it, because it's just as possible for this to continue. As a matter of fact, the NASDAQ looks just like this morning, but it continued. So what happens, right? It's all these people who jumped chasing it. This is another part of a possible swing. Now, if you go back and look in the blogs, I did a blog called Gap on the Left is a way to view markets, Gap on the Left. And what I was trying to show in that blog is just a very simple way to visually look for that big space, for that big gap, and then maybe mark about 50%. Just as a visual, just as a way to map the market. Okay? So this is very typical, and this comes out. And then you can develop tactics. It'll be if you're trying to get on the swing, there'll be a different tactic. It'll be, right, there's a little bit of a transition here. You're actually starting back over here again. So it's like this, and then this, right? So it's like you're actually starting back over. It's transitioning. It's that part, different tactics. And so you'll be waiting to use different bar tactics, like maybe an engulfing bar or another gap. Like this, to try and capture that run. Okay, but just notice, you can notice price, how it will, right? You can see when it gets like this. and then it, right, you can visually see the space in there. See, there's space in here. And then it starts to go like this. And the people who chase it here, if it turns around, you see it starts to come back with a big bar. But you can visually see this. Now, you never know if it's just going to reverse, if it'll stop 50%, or if it'll come all the way back to its base. But understanding part of the process, right? So you're in this part of the swing, you know. Understanding what part of the swing you are, you can develop tactics. But just look at any chart, any time frame, doesn't matter what you're trading. And you will see this dynamic, and it's very easy to see that gap on the left. So, all right. As we go through the series, right, today, just remember, we're just talking about learning how price moves. Okay? Not setting up any techniques yet. We need to learn how price moves. And then later on, when you understand, and we're just going to be working with swings and gaps, defining swings, defining gaps. That's all we're going to be working with to build our methods. Now, when you understand gaps, we can literally use this structure in a way to read the overall flow and just work with gaps and nothing else. We can use it for an entry, like right here. So you can see in the middle of a swing, I watch it. If it comes off, I'm willing to enter because this is a swing. We can use it for an entry. And we can even use this as a standalone setup in many ways, all by itself. Okay? So the more we understand about the way price moves, the more we can design. So just keep in mind that this is no different than the swing. This is your impulse, this is your impulse. Something's happening, it's in play. And from there we can work any part of the cycle. We can work the contraction phase as soon as it comes out of the contraction phase, the growth phase, and even this part, or the swing phase. So here at Language of Markets, in our live sessions, we started a project. Okay, we started a project where we're doing this as we go, designing some tactics and setups. So it's a stock project. We're going to build a portfolio of some stocks across the sectors and use it as a learning tool. And I'm putting out a list like this every month. And I know what we'll be doing, right? And we're going, in this particular plan, we're trading for a certain risk reward. We're going to know how we enter. We're going to know what gets us in, what gets us out. How, so this is we're using this as a learning project. So this was last month's picks based on different kinds of setups. So we're going to be moving into doing a lot more with stocks. I originally started trading stocks in the 90s. So we're going to be doing a lot more with stocks, and I'll keep you updated on that project. But whether it's the 2-minute ES, a currency, or some stocks, I'll show you some things I'm looking at. It's not difficult to look on a chart and just see that big space and see what I'm talking about is contraction, expansion, and then back to the mountain again. Right? It's not hard to see that space in here and realize whenever you get this, it's price lifting through something. It's price lifting through something. It's cracking something, right? It's in play now. And there's a general dynamic that goes on. It'll go up, people will get excited, It will begin to lose a little bit of steam. If it comes off, these people will chase out fast. And we can build tactics for that. You can see the bars, right? We can build tactics for that. So let me just leave you with one that I'm eyeballing. So it shouldn't be that hard to see when you look at a chart that, look at all that empty space. This is all gap. It's all gap, right? So as price falls back, we'll just basically be eyeballing it, right? And we'll be looking for a turn. We'll be playing in this part of the cycle. But you can see as they get excited, they start to slow down, and all the people who, now this is a daily stock, it doesn't matter, daily, weekly, monthly, you'll see this over and over. All the people who are in here, as soon as it starts to come off, they're gone. And there's nothing wrong with that. If you are playing with a tactic to be long here or to be long here, your money management needs to reflect that. It can be developed. But where you're trading in the cycle really needs to be understood if you're going to develop methods. So that's just the beginning. This is just the beginning. Then we can start to think about swings and add that into the mix. So we'll be watching this. And what will it look like if it turns around? Well, it's liable to go into a transition phase. And then what? Boom. And people will get excited. It'll either keep going or it'll fall back. And okay, so this isn't predicting markets. It's just following markets. Alright, so we'll come back with another video. Just a reminder, all we're doing is understanding this dynamic. And see it live. See it in all your charts. See it down. See when it goes up. See, it's a pretty normal thing over and over and over. You get the spurt up. They push. They fall back. You get the spurt up. They push. Look at the bar. They fall back. We just call that the scary drop. The scary drop. Alright. So until next time, just let it soak. And that's it.